I'm going to be talking about financial analysis. When you're looking at financial analysis, there are five key things that you need to be looking at. You're be looking at revenues, profits, operational efficiency, capital efficiency and solvency, which investors and creditors care a lot about, and liquidity, which investors and creditors also care a lot about. A large basis or a large reason for financial analysis is to determine kind of the financial health of a company as a whole. And to do that, a really important thing to have is a basis for comparison. And that can be other companies within the same industry, past performance of the same company, and it can also be contractual covenants, like whether or not a company is meeting certain debt covenants, like if they need to maintain certain cash reserves or a certain ratio, basically various debt covenants that they might have associated with their debt obligations. If they're meeting those, that can be a good sign that they're in good financial health. A large part of financial statement analysis is the use of ratios. And basically, this whole concept is called ratio analysis. And that's basically defined as a quantitative method of gaining insight into a company's liquidity, operational efficiency, and profitability. It uses data from current and past financial statements in order to come with ratios in order to give an indication of the financial health of the company. Firms within a certain industry should have similar ratios, and if they don't, that can be a signal as to whether or not, like, maybe they have a competitive advantage in a certain area, or it might be a weakness in a certain area. Any outliers within those ratios and comparing to other firms within the same industry can signify various things within a certain firm that can be the result of your financial analysis. Key ratios that are used within ratio analysis include liquidity ratios, and that's basically a company's ability to pay off its short-term obligations with its current assets. A few examples of that would be the current ratio, which is current assets divided by current liabilities. I mean, you'd want that to be higher. You want more assets than you have liabilities, and that just signifies a greater ability to pay off those liabilities with your current assets. Another example would be the quick ratio, which is just cash and cash equivalents plus marketable securities plus accounts receivable, all divided by your current liabilities. There are also solvency ratios, which compare a company's debt levels with its assets. Basically, it evaluates whether a company can stay afloat in the long run. A few examples of this would be the debt to equity ratio, which is just total debt divided by total equity. There's also the debt to assets ratio, which is total debt divided by total assets. There's also profitability ratios, which is basically how well can a company generate profit from its operations. And a few examples of profitability ratios would be the return on assets, which is just your net income divided by your average total assets, net income divided by total assets. There's the return on equity, which is your net income divided by shareholders' equity. And those two ratios just show how well a company is generating profit from its actual operations, because both of those use net income. There are the efficiency ratios, which basically show how well a company's assets are used to generate revenue. So that differentiates from the profitability ratios. A few examples of these would be the asset turnover, which is just net sales divided by average total assets, and the inventory turnover, which is cost of goods sold divided by average inventory for whatever period that you're actually looking at. There's coverage ratios, which basically they measure a company's ability to make interest payments and other obligations associated with its debt. So an example of this would be the debt service coverage ratio, which is net operating income divided by total debt service. There's also market prospect ratios, which investors use to determine what they may earn in return for their investment. A few examples of this would be the dividend yield, which is basically annual dividend per share divided by the market value per share. There's also the price to earnings ratio, which is just the stock price divided by EPS, earnings per share. When going about your financial analysis, there are multiple different ways that you can use. There's a multiples analysis, which there's different types of multiples analysis as well. But basically, a multiples analysis is just based on the idea that similar assets are priced similarly, and that a certain ratio can kind of represent all companies and firms within a certain industry. So they're all similar. Similar assets are similarly priced. And a goal is to basically, you want to determine what a stock price of a company may be, i.e. the company's value, and determine whether or not that stock is overvalued or undervalued given the current stock price. And once you determine whether it's overvalued or undervalued, you can make investment decisions based off that. For example, if an investor does a multiples analysis, or really any sort of analysis for that matter, and determines that the stock is overvalued, a good investment move might be to short it, because if they think it's overvalued, then eventually they think it's going to come down. Therefore, shorting the stock would be a good investment decision. Another way of financial analysis would be a discounted cash flow, and that basically values a company by forecasting cash flows and discounting those cash flows at an appropriate discount rate, and in the end arriving at a present value, like a current value for the stock price. This is also used to determine whether a company is undervalued or overvalued to make investment decisions based off of, and it just estimates the intrinsic value of a company. I'd like to take kind of like a method. I'd like to walk through a DCF that I'll be submitting along with this video, and it's just kind of to try to make it as interactive as possible. And there's a lot of details within the DCF, but I'm going to just do kind of like a really high level overview of what each tab in the DCF is. I'm not going to go into each formula because the formulas are demonstrated within the cell, but I will say it's really important that when you're doing a DCF, doing an Excel is great because you can link every formula to each cell, and so changing one thing changes everything within your discounted cash flow. So if you go ahead and you pull up your DCF that I submitted, this is a DCF valuation as well as a multiples evaluation that I completed for Spotify in 2018. So on the first tab, WACC stands for weighted average cost of capital. Basically, you're just figuring out how much the company, how much it costs them to raise capital. And this is, you can see in the formulas, this is all calculated, and this WACC is going to be used throughout the entire DCF. When you're doing a DCF, you have to make a lot of assumptions given like a lack of information. And it's helpful to outline those assumptions and where you got those assumptions, and a lot of the time maybe in a separate document why you thought those assumptions were appropriate. So in this assumptions tab, all of my assumptions for the income statement and the balance sheet are outlined, and you can, as we go on, you can see where they're coming from. So in the income statement tab, this is basically the income statement with forecasted numbers and how I got those numbers. Forecasted is in blue. The past year's information is not highlighted at all. And then in gray, you have either the growth rate I used or the assumption I used to calculate that forecasted number. This segment information is the exact same idea, except it drills down into each segment of the business. So you've got premium, you've got ad supported, and the consolidated. And that kind of is just a more specific way of forecasting various revenue or cost of revenue. Same exact idea with the balance sheet. You're basically going to go, okay, does it need a growth rate? Does it need to be a certain percentage of another line item? And you're just going to go line by line and forecast out all the years that you would need for your DCF. Now moving to the DCF, you're going to start with your revenue, and you're gonna go move down the line, and basically the goal, you can see, is to arrive at free cash flow at the end of the start of the DCF. And free cash flow is basically calculated by taking all the things you see above. And then you're going to need to discount your free cash flow, and that's going to give you your discounted free cash flow, and that is calculated off in the box to your right. If you scroll to the right, discounted free cash flow, the formula is outlined in that box as well. Next, you need to find your terminal value, which the formula for that is outlined in the text box to the right. And you can also just see it within the cell if you just double click on the cell, which is, again, it's also just very important to have everything linked together. So if you do change a number, it flows through the entire spreadsheet. And then you also need to take the present value of that terminal value. Next, you need to find your enterprise value, and that formula is, again, outlined within the cell, but also in the text box to the right. you're going to add back your cash and you're going to take out your debt, and then that gives you an equity value. And once you have your equity value, you can take that and you're just going to divide that by the number of shares, the total number of shares outstanding, and then that is going to give you an implied price. Now, in this particular one, we had it was in euros, and so you would just take the exchange rate and do it to dollars. You'd basically just switch to dollars in however way you want. Now, moving to the next tab, the EBITDA multiples. It's really important to have companies that compare. So we chose Alibaba, Netflix, Apple, Amazon, and Facebook because those were the best companies we thought we could compare that we could find an EBITDA multiple for. And we assigned them their weights based on the similarity of their business to Spotify's business. This was just an assumption. Again, going back to the assumptions that you need to make and outline why you thought they were appropriate. And then you take their EBITDA multiple, multiply it by a weight, and that gives you the Spotify kind of multiple. And you do that for each one, then you add it up, and that gives you kind of a sum of the weighted multiples. So that's going to be the 33.32 that you see. Then your terminal enterprise value is just going to be that multiple times the 2022 EBITDA, which was forecasted in the income statement tab. And then you're going to take that and divide it by your number of shares, and that's going to give you a share price, and then you're just going to discount that back. And you'll notice that those are very different numbers, and the primary reason for the difference in the discounted share price for the multiples analysis and the DCF analysis is just the sheer amount of assumptions you had to make for the DCF. That creates a lot of room for potential wiggle room within that share price. So all in all, two very common forms are the DCF and the multiples analysis. And I would say one of the number one things that's most important is basically you need to take account into your assumptions and be able to properly justify them in order to justify your share price and justify whether or not it's overvalued and undervalued. Thank you.